Let's define risk. Simply put, risk is the chance that something unfavorable will happen, or just the risk that something will go wrong. And in a lot of instances, people often describe risk as being uncertainty. But let's take an example of this lady who's doing this cliff hanging. And in this sense, she does face the risk of falling. But is that risk certain or uncertain? So, risk and certainty, while they do go together, there is a key difference in the sense that risk refers to the variability that can be quantified in terms of, of probabilities. That's why there's a whole academic study just based on risk management. Whereas for uncertainty, we can't quantify it. And when you are talking about risk management, you have to refer to Frank Knight and his classic definition that was done in 1921, where he just defines risk as known unknowns, which are quantifiable. For example, dice rolls, which are quite popular in statistics, and uncertainty are basically unknown unknowns, which are unquantifiable. For example, black swan events, or just things that you don't know can go wrong. Donald Rumsfeld, former United States Secretary of Defense, in a 2002 press briefing, also mentioned that there are things we know that we know. There are known unknowns, but there are also unknown unknowns. And if you're a fan of cartoons, I think also Boondocks, there is an episode that they mentioned that there are known knowns and known unknowns. So risk just is what we know that we don't know, but uncertainty now refers to just those things that we don't know that we don't know. And for companies, when it comes to risk management, you cannot only address risk, you also have to address uncertainty to the best of your ability. And that has been a large part of my work as a risk manager, just trying to think about those things that you don't know that you don't know. And it's an interesting dynamic from a risk perspective. Now, just tying it all in, when we're defining risk, it's not just about what things can go wrong. There are two key things, which is the likelihood of something going wrong and the impact of something once it goes wrong. So you have your low impact, high likelihood events, which are frequent but minor annoyances, and they require monitoring and process improvements, but won't necessarily impact your day to day operations. Then we have the low impact, low likelihood, which are just generally acceptable risks that may not require specific treatment. And then now we come to the high impact, high likelihood, which are critical risks that demand immediate attention and just a robust mitigation strategy. And I can give an example from a financial services point of view. A high impact and high likelihood will be not meeting your capital threshold because you had insufficient capital buffers. So if you don't have the capital buffers, then definitely you know that you won't meet your regulatory capital threshold, and you need to put in mitigations in place to ensure that you can meet your regulatory thresholds by just having that capital buffer. Now, you also have the high impact and low likelihood, which are significant events that are rare but must be managed, often through contingency planning or insurance. I can give an example of just a typical car accident. There is a low likelihood that you might face a road accident if you're driving your car. But if it does happen, that might have a high impact both in terms of financial as well as just physical repercussions. So by having insurance, you can protect yourself from both physical loss as well as be compensated for any um, just losses that may occur in that sense. Now, risk management now just refers to the practice of using processes, methods, and tools for quantifying and managing risks and uncertainties. And the process of risk management is just risk identification. That's the first step. The second step is risk assessment. Third one, risk control. And the fourth one is monitoring and review. And as the name suggests, it's a process, meaning it's something continuous. So as a risk manager, I found myself continuously identifying risks, potential threats that may lead to financial losses, cyber attacks, or operational failures. And you assess what's the likelihood of that risk happening and what will be the impact of that risk occurring. And some risks you can quantify, but others they are qualitative in nature. And for risk control, you can either decide to avoid completely that risk or transfer it by taking up insurance. You can also just accept it if it's just a low risk and low likelihood, like an annoyance. If you can go back to the previous slide, the low impact, low likelihood ones, which are just acceptable and may not require specific treatment. And for the monitoring and review, now this entails reporting and just continuous reviewing and adjusting of your strategies as needed to ensure that you cover all the risks. Now, when it comes to risk management, most organizations do have a risk management framework where at the board level, there are risk policies and governance mechanisms that are set up by the board. You have policy statements, you have risk appetite statements, and all these have to be formulated by the board. Or if you're running your own company, as the sole proprietor or just as the manager, you have now to set up what are you willing to do? What are the risks that you are comfortable taking, and which risks are you not comfortable in taking? And now, for an organization, you have the risk oversight, which is typically performed by the risk function, your risk managers, the chief risk officers, and the likes, who now carry out the day-to-day identification, assessment, control, and monitoring of the risks. But the risk owners for most organizations are the day-to-day business units. They are the ones who are the client-facing teams, your relationship managers, the tellers at the branch. Those are the ones, the branch managers. They're the ones who are in charge of the day-to-day management of the risk, just ensuring that they can minimize and protect the organization as much as possible. But there also has to be an oversight body that just monitors what those guys are doing, because in a lot of instances, they may not be cognizant of what needs to be done in terms of risk management. And there's also that element of laxity, where you do something for such a long period of time that you just become numb and you're unable to identify what might go wrong. So this one is typically known as the three levels of risk management, or the three lines of defense, where now you have the business unit at the forefront, then you have the control functions, mostly risk as well as audit, and the third line is typically now the external auditors who prepare the external audit reports and just uh, submit this to the board, just giving an independent view for most organizations. Now, when you're talking about risk for organizations, they are both external and internal sources of risk, where for the external sources, you just have the global economy, for example, global fluctuations. If you are a global company, for example, Apple has to protect itself against currency fluctuations, just given the fact that it operates in multiple jurisdictions and its operations are run in different currencies. Also have the political arena, the trade tariffs. If you're watching this video in 2025, where Donald Trump had rolled out trade tariffs, and this really did disrupt the global economy in terms of just uncertainty regarding the cost of goods and how business will need to be conducted moving forward. Also have competitive environment. You can imagine if a rival launches a cheaper alternative to your product, which just undercuts your profit, that is a significant source of risk for any organization. And you also have social and market forces, for example, consumer preference shift. A good example of this is the tobacco industry, where the society decided that smoking is horrible, but slowly there has been the rise of these vapes, or now this nicotine products where people are vaping, and that is more acceptable but still harmful, but it has provided a lifeline to those tobacco industries. And we also have environmental and social governance factors that are becoming more and more important. For example, if you're treating your employees poorly, the sweatshops in China, or just the use of child labor in some Asian countries, as well as just the impact of certain operations on the overall environment. For example, if you get an oil spill, that oil company can be held accountable, and it will definitely present a risk in terms of even fines. And you also have technology and cybersecurity, which are emerging external sources of risk for most companies. We've had hacks where data has been lost, data breaches, and also just new technology that can render a company's technology obsolete. So all these are external sources of risk. And now for the internal sources of risk, we do have strategic risk. What if your game plan is wrong from the get-go and you can't properly implement decisions? For example, just a company using the wrong strategy overall. I can give an example of a football club, for example, Manchester United in 2025, the 2024 to 2025 season, they did have quite bad results, and you could argue that this was tied to their player signing strategy and overall club management strategy, which took a downturn. Another source of internal risk is just operational risk, which is defined as the risk of loss arising from inadequate or failed internal processes, people, and systems, or from external events. So, for example, system downtime due to having a server issue where your customers cannot access an app or your platform. That is a great source of internal risk. And lastly, we have financial risk, which is broken down into credit, market, and liquidity risks. Where for credit risk, for example, if you're a bank and you issue a loan and the person who took the loan is unable to pay, that's a risk which you have to consider before you issue your loan. For market risk, this also applies to any organization that invests in assets. For example, if you're investing in the stock market, there is a risk that the price might go against you. So you buy your asset for, let's say, $2, and after 2 days it's valued at $1. That's a risk. But with risk also comes reward, because on the flip side, if you bought it at $2 and it appreciates to $4, you can make some profit on the capital gains. And lastly, liquidity risk, which affects most people and also organizations, which arises from you not being able to meet your obligations due to poor cash flow management. So if you get a salary and you're unable to manage your expenses well, you might find you're not able to meet your rent obligations or other debt obligations. So this also falls under financial risk. So in this video, the main thing was just to introduce you to what risk and risk management is, as well as the sources of risk for a company from an internal and external point of view. And be sure to like and subscribe, and I'll be putting out weekly videos just discussing more and more risk topics. But for now, thank you so much for just going through this video. If you have any comments or questions, leave them down below, and I'll catch you guys in the next one. Bye.